some of the titles that ChatGPT came up with. Tuesdays with the financial planners, investing in retirement strategies. That feels like Tuesdays with Maury, like that. That was done. Investing in your future, a weekly podcast with two CFPs. These ChatGPT came up with absolutely the most boring possible titles for an investing.
Did you say podcast?
I did. The prompt, ChatGPT is all about prompts. And so give me 10 titles for an investing podcast between two certified financial planners that takes place on Tuesdays. Because the more specific you are, the better it is. And I can vouch for that because I use this with the kid bedtime stories, like I've told you.
Oh, yeah.
So it gave really lousy results. And so I said, give me 10 clever or funny titles. And it came up with like the Retirement Hootenanny, a podcast that's better than bingo.
Well, I mean,
like, what?
It's got to be clean. You said funny, like it's got to be like, it's got to be short, right? It's not gonna, I don't know.
Yeah, we'll workshop these.
Yeah.
All right, welcome back to the latest installment of one of the Ford Financial Group webinars, web series, web broadcasts. I'm not sure exactly what we're calling it. Ryan and I'm joined with Ryan Louie, who's one of the advisors in our office and a certified financial planner. My name's Brian Ullman. I'm also an advisor and certified financial planner at Ford Financial Group. And we do these videos from time to time to keep clients updated on what's going on, provide a little bit of perspective on investing and retirement planning, of course. And we've typically done these on Fridays, but Ryan, we've been trying to come up with an idea for a new name for these in case we're not posting them on Fridays. Because Casual Friday doesn't cut it on a Tuesday, does it?
No. Yeah, that might be a little bit confusing.
Yeah. Well, I'll tell you what, if you're watching this or if you're listening to this on the podcast and you have ideas for our new web series that we're doing midweek, you can email them to us at info@fordfg.com. We are all ears for your suggestions. If you're watching this on our YouTube channel, I would say subscribe so that way you don't miss out on new episodes that Ryan and I record a little bit more regularly than we've done here in the recent past. And if you're listening to this or this has been forwarded to you on a podcast, you can find us the audio versions of this posted on Spotify, Apple Podcasts, or wherever you get your podcasts. You can subscribe there so you can at least listen if you're not watching some of the charts. We'll try and include some of the charts and some of the show notes on the podcast recordings there. So, all right, Ryan, let's dig in because it's been a while since we've done one of these. I know we've done the Casual Fridays, podcast, webcast, video recording that we do on Fridays, kind of when we have the luxury on Fridays of having kind of knowing usually when we're recording this about how the market's closed for the week. We don't have that exactly right now, but we can say, even if we just look year to date, things have gone pretty well. I mean, you think NASDAQ's up almost 20% year to date. S&P's up almost 8.25%. I mean, is this how you saw the first almost 4 months of the year going?
No, I mean, obviously we came off of a tough year last year and started off hot and gave it all back. It seemed like in February, and surprisingly, the market is very hard to predict, as many people probably can guess. We had even like March was a bank debacle was happening, right? And it was scaring everyone with everything that was happening with the bank. But surprisingly, it didn't really affect the markets that much. There was a few days here and there in which it did, but overall, the markets were relatively quiet given all the issues. And again, if you knew that there was a banking issue that was going to go on with this kind of news, I think most people would have guessed that there would have been a lot more volatility. But again, it's hard to predict which way the market's going to go based upon what's happening.
Yeah, absolutely. Here, I'm gonna share my screen and everybody can kind of take a look. This is how things, we were talking. This is year to date. Just kind of looking at the NASDAQ, Dow, S&P, and the Russell, which not a whole lot of people follow. But you can see here, even if we pull this back, like this is the banking stuff right here, right? We were kind of humming along. We hit peaks in February, mid-February, early February. And then we were kind of meandering, I guess maybe markets kind of sensing that there is trouble afoot with banks. But then, we got this dip, but then we become charging, especially tech stocks, mega cap tech, they're charging back. Now, if you go for the rolling 1 year, Dow is still doing well, but I think if you had asked anybody at this point if they thought over the last 12 months if the Dow was down only 1.33%, they probably wouldn't have believed you. I mean,
Right.
even the Nasdaq's down only almost 6.
Yeah, I think there's a little bit behind this in terms of, we've heard this before, where from the stock market world, that bad news could be good news. And from this standpoint, I think that everyone, as investors, wants interest rate hikes from the Fed to be done with. And so, maybe the banking issues helped solidify that interest rates can't go up forever. Not that they were ever going to, but it seemed like it. And maybe that put a more immediate cap on the interest rates.
Well, the Fed certainly has said as much. They think a recession's on the way. They've said so. Their staff report in the FOMC minutes said so. And so I think whether they raise rates another 0.25% or not, what's the difference? We're there. Sure. We've reached the finish line. And then so the question is, what happens next? Are markets being overly optimistic about what's coming? Yeah, I would say they're being aggressively optimistic, saying the Fed's going to cut rates. I think you picked out our next chart that we're going to review, Ryan, which is the Fed interest rates and expectations. This is not this comes from the JP Morgan Guide to Markets, and this is showing what the Fed where the Fed's been, and the Fed expectations versus market expectations. They're not aligned, right?
Yeah, well, there's a few things to probably take away. It's kind of nice to see the history of where Fed funds rates have gone, just because you can see here, we were over 15 years ago, we were at about these interest rates for a little while before they came down. And then you could also see in the kind of the early 2000s, interest rates were even higher than where we are now. There's a couple of takeaways I kind of see from this chart, which is once interest rates get to, they get to their highs, they don't usually stay there too long. That was one of the narratives too that we were dealing with not that long ago, a couple months ago, was that the thought was they were going to raise interest rates and kind of keep the interest rates high for longer than we expected. But then you kind of look at these expectations, which are these different, lines at the green and the blue lines. It maybe shows that really we're not going to stay high for very long. We don't know, but even in the history,
doesn't even know, right?
Well, even the history of things, the last 3 times, the interest rates didn't stay long forever.
No, not forever, but they did stay. I guess they didn't peak and come right back down. Because if you go, a couple of things strike me in this chart. One is rates have been higher in the past, but I don't think the speed at which we moved higher is different. This also doesn't tell the whole story, right? Because the money supply is going down. The Fed has quantitative tightening at play, not just easing. And so, what they're doing with rates is only a piece of kind of the whole story of the Fed trying to cool things off. But you can look back, whether you're looking back kind of 2000 right there, you look back 2005, rates plateaued for a while. And even though the market expectation is for Fed, well, it's pretty clear that there's an expectation of, at least by some, that they're going to cut rates later this year. I think that the Fed is going to have this kind of plateau. For how long, I don't know. But I think ideally, if they're not breaking anything and they don't have any more banks failing, I think the Fed would like to keep rates at 5% for the balance of the year.
Yeah, I think from an inflation standpoint, they would love to keep the interest rates just flattened out and high for longer. But I think that with the banking issues that have happened recently, they may not be able to potentially. There's maybe some underlying issues that would lead them to need to maybe lower interest rates potentially, just to help out some of the banks potentially. Obviously, if a recession comes, that's the big wild card. We know what the reaction typically is for a future recession. Is they use interest rates as a tool to get us back out. So there's a lot of ifs to all of this.
Yeah, absolutely. And no one knows. The Fed doesn't even know because it's dependent on a few things. happening or not happening, right? Whether it's a recession and they need to do something, the banks need to do something. I think though the Fed is going to hold out as long as they can, and if the Fed has a tendency to be late, they could even be late on this situation. I just don't think rates are their ammunition to fight fires, right? I'm mixing up my analogies here. It's the water that they use to fight fires, and if we have a fire beginning, they don't want to use all of that too early. They want to be able to know that they have to deploy that, right? And so if they can keep rates at 5, then they can cut rates when things get bad without having to start doing quantitative easing and things like that.
Yeah, well, I think that their biggest fear probably is, of course, lowering interest rates too soon. Inflation goes back up, right? And that could happen because if we think about people's expectations and they see the interest rates go down, people are more likely to spend money.
Right.
If interest rates go down, as we've already seen the last month or so, with the expectation that's going to come down, the markets go up. People have more money in their investment accounts. Again, they're more likely to spend money, and that leads to potential inflation going back up again, which is their number one concern.
Sure. Yeah, you're absolutely right. It's going to be interesting to watch this play. I think the thing that everybody can agree on is that no one knows. No one knows for sure.
Always.
And so we're left with looking at history and saying what goes on in history. I think the next slide that we've got here is another one from the JP Morgan Guide to Markets. Now this is current through the end of the quarter, and I know that we just looked at what the S&P is doing. It's doing a little bit better than what's shown here, but this is intra-year declines versus calendar year returns, and I love this one, and it's especially helpful when we look and see, okay, how bad can things get and still rebound? And what I find interesting is that you can get pretty deep drawdowns and still make it back to break even. And in this year, we're down 8% was the maximum drawdown, and that's probably what went on with the banking issues that were going on. But we're still up 7% on the year through the first quarter on the S&P, and more importantly, we have many more good years than bad, and rarely finish at the depths of where markets were. Last year, S&P was down 19%, but at the October lows, we were down 25% on the year.
The hard thing about knowing and guessing, again, as we said, you can't guess where the markets are going to go.
No.
But you look at this, and there's only really right in the middle of the chart, you had the early 2000s where we had multiple years down. But most of the other times, you have a year that goes down, and then you have multiple years afterwards that goes up. Obviously, we are hoping that is the case this time around as well, as we don't want to have a repeat of the.
Well, let's talk about that stretch though. That was a tech bubble burst that probably would have been digested in a year. But then on top of that, you've got 9/11, and on top of that, you've got the Enron accounting scandal. It
Which
was
tied in with a recession that was going on.
It was a mess. And everybody forgets we were mailing out stimulus checks in the early 2000s. We were doing something. We were fighting those kinds of fires, and I would say the kind of difficulty that we've had so far hasn't, whether it's the blowout in the spectacular blowout in cryptocurrency last year, or just the revaluation of some of those tech names that are the COVID darlings, it hasn't infected everything else the way maybe the tech bubble popping did in the early 2000s. But in many of these, you can go back, whether you're looking at 1981, you're looking at the early 90s, early 2000s, interest rates go up, they pop some sort of bubble that's festering, and then interest rates go back down, and you have this solid run going forward. Even if you look in just 2018, that negative 6% with a 20% drawdown, interest rates were rising, right? Go back to this 2018, right? Rates were going up. And so you can, lots of things go into this, but you can pretty reliably say rates go up, we endure the pain, rates go back down, and things carry on.
Right.
I don't know. This to me looks like the beginnings of things carrying on. There is forever this debate going on right now of, are the October lows it, or are we going to have capitulation at some point down the road where markets flush and we finally get it out of our system and break the fever? I don't know. Do you want to weigh in? Do you think the October lows are it?
I think, from my professional opinion, our market is going to be dependent upon if we have that recession or not. And it seems as if you can flip a coin, whether, you get commentary on it. It seems like half the people say yes, half the people say no. Some people say we're already in it. It's all of these different things. And you could get into the definition of a recession, and recessions don't happen when jobs are this good. I mean, there's all kinds of different components to this, but
so you're saying that if we get a recession, then we will find new lows in the S&P, for example.
I mean, historically, if you have a recession,
it's not priced in yet, in other words.
Yes, right. So historically, if you have a recession, you don't price in the lows of the market before the recession was even happened, right?
For 500 days before the recession?
Like the market found its bottom before things actually even got bad. Like that doesn't make sense. So think about from that terms, if we were to go into recession, I do think we will see much more volatility. Probably you would see something lower than the October lows. But then again, maybe there's something that allows us to escape it. And then the markets are fine. And again, this is what makes the markets so difficult. It's because I don't think that we really can feel if we're definitively heading to a recession at this point.
Well, having the market peak almost 500 days before the recession, you're right, is early. But we're living through first, so who knows, right? Who knows? I mean, I don't know.
You can ask ChatGPT what it thinks about the recession.
There you go. Well, we've never done this before,
right?
We haven't shut down the economy and flooded the system with money and kept interest rates artificially low. And at the same turn, like we haven't done all these things. We're still digesting our COVID policies. And just like we were kind of trying to figure it out as we were going with COVID. We're trying to figure it out as we're going after COVID. And that's why, as we sit here, we joke around, there's no telling. There's no telling if a recession is a soft landing, if we're going to have, unemployment rate's 3%. What if it's 6%? Okay, well, that's not great if you're losing your job, but it's also not as bad as what we've had in the last couple of decades. I don't know. It's going to be interesting to see how this plays out. But if this chart always kind of provides a little bit of peace, right? Where you say, okay, it's very rarely as bad as the depths of the year. And then you start stringing these years together and you have more good than bad.
I would say like a very good takeaway for this is that, as everyone knows, there's lots of volatility in the markets. You're going to have your downs. You have to almost really be willing to obviously accept these downs, down markets that you have. Yep. In order to get the good markets, which is all those lines of positive returns that happen in most of the years.
Right. Well, and it's some of this is investment performance, but also some of it is for investors. It comes down to your diligence, not don't cut and run. You want to make sure that you've got your portfolio situated in a way that works for you and your finances. And part of what I was talking to a client earlier today, talking about how he's in his 40s. He wants to really kind of start supercharging his investment portfolios. And, I was talking with him and I said, it's two things. It's investment returns and contributions. If you can contribute like crazy to your savings account, but if you're not getting any return on your money, you're not going to see the kind of growth that you're talking about. Likewise, if you contribute once to your investment account and relying on the market to grow and compound year over year over year, you're not going to see that supercharge. It's two things. It's contribution, or three things: contributions, returns, time. Right, all in that same cauldron working together.
Yeah, and I usually tell people, obviously, the one thing that you have control over is the contributions that you could be making. Right, if you can keep contributing, the more that you can contribute. If you can, cut back on some of your personal finances or spending, that especially things that you're not using or doing anyways, and can then contribute more. Those are the things that are going to add to it, because you're not going to have control of the markets. B, if you're counting on something like an 18% annualized return for the next 20 years to get to your goals, that's probably not going to happen. And so therefore you got to make up for getting to your goals by putting more money in and trying to find out how you can do that.
Well, it's too important to go for broke. Like when I'm playing tennis against you, I'm not good enough to play conservatively. I've got to go for it because you're too good. But that's not an investment strategy. That's not a retirement planning strategy. And so kind of in that same vein, we can wrap up with this last chart that we've got here. I think it's interesting. This is a how withdrawal rates affect the longevity of your portfolio. And this starts in the year 2000. And your withdrawal rate's determined by your first withdrawal rate here. So it's not adjusting, but it adjusts for inflation as it goes. And you can see if you had $500,000 and starting in 2000 and you had an 8% rate of withdrawal, you would have been out of money a decade ago. Whereas if you had a 7% rate of withdrawal, you'd be out of money, but you would have lasted even longer. But look at if someone's with that 4% withdrawal rate. Yeah, you're not at your all-time high that you were at January of last year, but are you really sweating it? You've been getting more than 2 decades of withdrawals, helping to supplement your retirement income through Social Security pensions or whatever. And
you have about the same amount.
And you have about the same amount.
And to add to that, they started this at one of the worst markets we've had in quite a while. And then on top of it, you have the 2008 market, which was a horrific market by all standards. And then you had COVID. And, so we've had some very bad markets in the last, call it 23 years.
Well, talk about sequence of returns. I mean, we'll save that for another one of these. But your 3 of your negative years came right out of the gate. And you're still okay. And you've had the worst financial crisis in your lifetime in 2008, and you're still okay.
So this goes back to the same thing that we were just talking about, where the things that you can control, right? On the front end, when you're saving money and you're trying to build up your retirement, the one thing you can control is putting more away into your retirement.
Right.
On the back end of things, the idea is to not withdraw too much money on an annual basis that could end up really hurting your situation. And sometimes I will say this, it's for clients that I've worked with, it's not always the annual distribution, right? It's not saying, oh, okay, I'm going to take out 8%, which is a high number. It's probably therefore not going to last the person's entire retirement because it's too high of a withdrawal. You also have the clients that they'll take a monthly withdrawal, but then periodically they take out lump sums, right? And so while it's not 8% a year, it's every couple of years they take out an extra $10,000, $20,000 to do this, to do that, and that really does speed up the decline of the account value as well when you're doing those one-off withdrawals on top of everything else.
Absolutely. I think these charts are kind of telling, right? Because whether you're talking, the Federal Reserve one is interesting and it provides some history, but especially the last two, whether it's the performance of the S&P over time or your withdrawal rate, this is about diligence. This is a game of years. It's a longevity thing of discipline more than it is what's the market doing today and what's the best stock pick and are you doing growth or value or large or small or domestic or international. It's like all that stuff kind of washes away when you pull the lens back and say, okay, more broadly, how do these things operate? And hopefully that gives everybody a little bit of understanding. And when you have some understanding, it provides a little bit of patience as well, I think we're going to leave it there. Those are 3 charts, Ryan. We'll do this more often. So that way we can kind of keep up with maybe some current events.
Hopefully just bring current events, talk about them, give people some of what our thoughts are. Sometimes we sometimes get a good pulse, I feel like, because clients call in, or when we have meetings with clients, sometimes we'll get the same questions over and over again, in which case we know if 3 or 4 clients are thinking about it, that probably means a set of other clients are thinking about but haven't asked yet. So this gives us an opportunity to get out and answer some of these concerns or thoughts.
Absolutely. Well, we'll keep doing it. I look forward to it, Ryan. Thanks.
Yeah. All right. Thanks.